Hello, it's July the 20th, 2023. I'm Matthew Holt, founder and publisher of the Healthcare blog, and it is THCB gang. It's a regular time where a bunch of people get together and discuss healthcare. And this week, fun lineup with a great special guest. Regulars Jeff Goldsmith from Health Futures, Robin Farmanfarmaian. I can still never pronounce Robin's name ever. Robin Triple F from who's patient and CEO, but also advising gazillion companies, and John Neptune, Suntra Modern Recovery, and also a podcast. God, I'm blanking on the name of your podcast, JL. Is it
serious? Question mark.
Is it normal? The answer is it serious, right? And this week we have a special guest, Sofia Guerra, one of the leading sort of newcomers to the venture comers to the venture capital scene at Bessemer Ventures, who will be telling us about some of her recent report and some other stuff, where I'm watching some under 12 girls water polo, which is a bit like watching the World Cup. The Women's World Cup has started, actually, right? The host got a win over Norway, so well done to them. Well done to New Zealand. And it's been another busy week of random stuff happening across the country, some of it impacting healthcare. Most of the news that I've been watching has been dominated by either the small matter of the ex-president being indicted for the millionth time, or a lot about this week, a lot of saber rattling around China and Taiwan, which is worrying me a little bit. And I do remember a few months ago, probably a year or two ago, we were talking about wildcards, Jeff and I, about things that might worry us. And one was China, Taiwan, and the other one was Ukraine being invaded by Russia. And half of that happened already. So there we go. All right, so let's kick it off. Let's quickly go around, and then we will dig in on what Sofia's been up to. Let's just quickly go around and ask people what they've been working on, what they're looking at in the world of healthcare. And I will start with you, Robin.
So hi, everyone. What I do typically is I talk about the shift in care to the patient's home in a lot of my keynotes. And I just saw in Stat News this morning that the FTC is starting to look at these monopolies. So what we're seeing is, that vertical integration with CVS, Aetna, Walmart, United, Humana, and they're all purchasing these big companies that provide care in the home. And the FTC is finally noticed. And so I'm kind of interested to see where this goes.
Yeah, a lot going on in that world. JL.
I'm very interested in President Biden and their clear push to leaning into healthcare and healthcare costs. They announced about a week ago, maybe 13 days ago, a series of actions that they're taking about on issues like surprise medical bills, junk health insurance, and other things that negatively impact people from the standpoint of their healthcare and specifically the cost of their healthcare. And it's exciting to see that the president is still interested in healthcare and is working to make healthcare better for the typical American.
I like it. I don't think anyone's noticing anything the president and his party is saying. They are trying to shout quite loudly. There was a lot of political noise. And I know that in my house, we get the Joe Scarborough Morning Joe podcast. I don't think he ever talks about the current president who's in power. A lot of conversation about the previous guy.
Yeah.
So, and I think as we get more and more into both indictment and primary season, it's going to be really hard for them to wave the flag. Even though, if you look at the economic numbers that have been coming out, there's a lot of doom and gloom forecast, but things are pretty damn good at the moment. Anyway, Jeff.
Well, I was interested in United Health Group's second quarter earnings release. They're headed at a gallop towards being 10% of our healthcare system. What interested me about the earnings release was Optum Health is roughly now the size of Kaiser, a little north of $90 billion. But the bottom line percentage is falling. It was 10% in 2018. It's like 6.6% now. And sure enough, Wyatt Decker, who's run the unit for 5 years, was moved aside this week and replaced by Amar Desai, a person I don't know, has a superb reputation, spent 9 months at the Three Ring Circus, otherwise known as CVS, and returned to run Optum Health The key difference between Desai and Wyatt is the extensive experience that Desai had running Healthcare Partners, which was a fully capitated, very well organized and focused medical group. Now, Wyatt Decker was a Mayo alum with no risk experience to speak of. So I thought that the move in, what is emerging as the most significant piece of United Health Group, other than their health plan operations, I think there's ripples of anxiety in this move. And I found it really interesting. Wyatt Decker has a great reputation. He's very smart. He's very well spoken. But there may have been accumulating frustration with his ability or inability to absorb all those acquisitions. So,
Well, I think Sophia will probably get into this because Optum will be at least an exit for many of the investments that we've been talking that you've been talking about. But to me, one of the things is, as you get bigger, it's hard to sustain growth, and also the shift from being a technology company only to being a technology and services company that owns a bunch of medical groups that are not known for having 10 to 20% margins. It's going to be something which is obviously increasingly coming on for them. So Sophia, let me introduce you a little bit. You've been at Bessemer for a while. Bessemer you can tell us a little bit more about the fund. Your colleague Steve Krause, who used to have his own podcast, by the way, with I think it was from Trevor Price with Oxygen for a while. I used to describe him as the guy with the bushy eyebrows from on the podcast, and he used to get groovy. But obviously, you guys have been involved in Bessemer as a fund, and you as well have been involved in digital health investing for some time now. And a few months back, I think it's why we got together. Is it you wrote a report about how do you get to $100 million in ARR as a digital health company? One of the things that people have to do what companies have to do. The other thing is, and you and I had a little back and forth on our Slack groups, on the Health Tech Nerd Slack group. Okay, that's great. How do you get there and actually become a profitable company? So I'd love you to say a little bit about what you look at, not only this week, but in general, when you're out looking for companies to invest in, what you're looking at, what you think is exciting, and what where you think the market is heading, especially given what we just heard about healthcare costs, monopolies, and moving to the home, and the whole overview of Optum. But again, pick it up. But tell us a bit more about how you think about the healthcare system, the investing landscape.
Thanks, Matthew, for having me. I feel like you always ask the hard questions when I post my reports, and always keeping me on my toes.
This is why they pay you investors, the millions of dollars a year, right?
I wish, especially not in this market. But no, thanks for having me. I appreciate you kind of making the space to share a little bit more about me and the work that I've been doing. There's a quick kind of file background and how we spend time. So I'm the most recent addition to the Bessemer team, but I've been there over 2 years now, which is kind of crazy. And I had the opportunity to join at kind of this peak market, kind of early 2021, where the processes were incredibly fast. We were spending days doing diligence on companies, and there were so many different splash valuations that were in the news. And then 6 or 8 months in, I just started asking all those questions of fundamentally, maybe the top line of those businesses looks really good, but fundamentally seeing kind of gross margins and below the line and how you scale and repeat kind of that go to market. I had a lot of questions, and even like during budgeting season with our own portfolio companies, and where we were making decisions to spending money when the risk of raising money was low, and you kind of have a lot of capital, you get to spend it and grow at all costs, right? And making those budgeting decisions and how to benchmark to other companies came up. And I just started asking Steve, like, hey, Bessemer has been investing in the world of digital health for almost 15 years since he kind of started looking at this space. And I know, Matt, you're the healthcare OG, but I like to joke that Steve's also been a healthcare OG. And I just started taking a bunch of the knowledge that Bessemer had and studying, and then building longitudinally the P&Ls of a bunch of those companies to see how they've scaled over time. How long did it take them to get to certain milestones, and what were the milestones that we were all looking towards? Was it revenue growth year over year? Was it gross margins? And like you're saying, Matthew, the profitability or gross profit, as well as kind of EBITDA and free cash flow, which is ultimately the goal of any business, is to make money. Well, in healthcare, there are other goals that are more important, and I believe are going to accelerate your way of scaling and getting scaling the impact, is obviously caring about the patient and the outcomes that you're producing your solutions as well. So it's kind of a double fold, and the priorities will shift over time as you kind of go from Series A to Series B to Series C. So anyway, long-winded way of saying the goal of my research was thinking about how to quantify how those companies have scaled, and how do those milestones or KPIs, key performance indicators, has changed over time as those companies grow. And then what are the differences between the business models? Because I feel like we can't just categorize all healthcare companies into one bucket and assume they're all the same. They all have different stakeholders. They all have different business models, different ways of monetizing. And the more that we can derive quantitative analysis and comparisons, the better armed we're going to be at building great businesses.
So could you take a moment to give us the flavor of what those divisions were? Obviously, there's pure technical services, and you laid a few of them out, and some of those key milestones in your report, in your thinking. So can you lay that out just a little bit for us? So the way you like to think about the differences between companies, and of course, whether that has an impact on success. You think success and failure.
Yeah, can I share a slide? Is that possible?
Sure. Go ahead and share it. It may not work during the podcast version. If you watch the video, we'll see it.
All right. Yes. So, I mean, this is just visuals, and I have, because there's a lot of data too, we can jump into some of these, but high level, we categorize the companies into two business models, and there's a lot of sub segments there that I'm working on actually as you increase the end of companies to actually have more benchmarks. But at a high level, we thought of healthcare technology as both healthcare software or SaaS. And these are businesses that are very similar to what all of my colleagues at Bessemer invest in, cloud software as a service business. It is likely a B2B sale software, largely to also include data and analytics or cloud businesses. And it's highly recurring revenue. We talk about CAR and ARR as kind of those top line measurements, and they tend to be enterprise contracts or kind of per seat licensing. And the few examples that I have here at the bottom are two the very successful companies in the space that are publicly today, both Doximity, which is not a very traditional SaaS business, but it has SaaS-like behavior, and then Viva, which is a software business that sells to pharma companies, and then two examples in our portfolio company. And then the second bucket is the tech-enabled services businesses. This is a big umbrella. It's not perfect, messy way of breaking out the world, but the way we think about this is they're either B2B2C or D2C businesses that end up touching the patient one way or another, either from care delivery or navigation. And it's like very transactional in nature. You're providing a service and you're leveraging technology to do that better. So the way that technology is embedded in that process will vary depending on the acuity, the where you're providing the care, and the model. And then there's also kind of significant clinician costs or people costs that are involved in this. The best examples of this in the public market are Livongo, which is the darling of digital health, and Accolade. And then the other examples in our portfolio company include Hinge and Headspace.
I think you could say was the darling of digital health.
Yeah, was.
was is the answer I'd use there. So
good outcome.
Yeah, great outcome if you were actually, to be fair, if you whoever you were, as long as you hung on for 6 months and then got filed out. But and actually, they I think it was essentially now integrated decently well into Teladoc as a product company. It just took I think for they Glenn Tillman took advantage of well, everybody, but you know, the height of craziness there, right? To get out and do very well.
Matthew,
Jeff, please dive in.
Sophia, I made an attempt to read your report and really struggled. I mean, there was obviously a lot of work that went into this, but I'm really kind of looking for the bottom line conclusions that you reached about how to grow these things. And I want to preface that question or add to it by saying, and I think Livongo is a great example, how many of these companies were built to sell to someone else to yield a profitable exit for their initial investors, as opposed to companies that were going to be enduring, continuing to grow, continuing to add earnings types of companies. So I guess I missed the message in your piece, and maybe it was just because I needed to read it twice.
No, I mean, it's a great question. And obviously we're not investors in all of the companies that are included in the report, right? The 100+ companies. These are companies that are public, that we've evaluated over the many years, and that we're investors. So it's a full gamut of venture-backed businesses. I mean, our goal as investors is to back the enduring companies, right? That's why we have like the $100 million milestone in the report. Is you kind of need to get that to that threshold to become a public company, and become an enduring business. But there are many other ways in which you can have a good outcome and be part of a larger organization. I won't say that's a bad outcome, right? So kind of want to clarify a little bit more your question on that. I mean, the high level, or like the key takeaways from the report would be like building in healthcare is really hard, and it should be looked at differently than what we look at other businesses in other places, because there are certain nuances to healthcare, the complexity and regulation, the buyers and how they behave, and the types of stakeholders, and candidly, the economics and how you make money are very different than if you were just building a software business. That's kind of how I would probably qualify the biggest takeaways, and especially for the tech-enabled services category.
How many of the companies were generating positive cash flow that were in your sample, that had reached the point, forget about the $100 million top line, we're actually generating black ink? How many of the 100 plus?
Of the 100, I don't know the exact number, but if you look at, I'll show you.
While you're looking, let me modify the question. What gets me about this is not how many were generating that at the time when they got their last round or when they went public or what have you. It's what happened since, right? So if you look at the ones who went public pretty early, the ones who went public, a few of them, you mentioned Viva, who's kind of a healthcare company. It's a CRM company that sells into drug companies, but I think of GoodRx and Doximity, right, who are on the fringes of healthcare. They're not in there trying to change healthcare, but it's a healthcare related sort of SaaS product. You know, they were already profitable pretty damn early on, you know, way back when. Doximity took in 50 million bucks of canvases, Rebecca Lynn canvases, money it didn't need, it never spent. If you look at that, you know, they were always profitable, which was a very expensive piece of VC to give away because it cost them $2 billion at their IPO. But you know, it seems to me that the question is, when you have the people who were losing a ton of money but growing fast, the Livongos, the Teladocs, a lot of the other companies you mentioned, none of them seem to have flipped the switch that typical SaaS companies do, where they get to some point where they're all of a sudden it's all pure profit, right? The revenue is bumping up above the costs. And I don't know if that's because they were service-enabled businesses or because what. But then if you go down the list of publicly traded companies, I mean, it's not as though they got there and they were able to turn on profitability. It's pretty much it's been a kind of disaster, which is why public markets have now, turned against the idea of we'll be profitable one day, decimated them. So I'm wondering, is there a switch that we're missing here, or am I missing something? Is it coming for these companies? Is the $100 million in revenue the magic marker, which they're going to start getting there, or is that
no? Believe me, many companies are way past the $1 billion in revenue marker. So I don't think that's it. I think that I'll flip your statement a little bit, because I don't think that because you're a public company out of the sudden you're going to become profitable or you're going to hit a certain milestone. The markets were rewarding that type of behavior in the public market. If you saw like a year and a half ago, the correlation of how you were valued is how fast you were growing and the
Right.
multiple that was placing.
Yep.
That has since changed, but it's not because the public market realized, oh, there are all these profitable companies. It was because the $1 invested in one of those companies had a different risk reward than what they could put it elsewhere. And it's because rising interest rates and some other macroeconomics that have shifted investors in the public market wanting to put that dollar somewhere that's more profitable than otherwise. And it's taking time for companies to adjust. I mean, inherently, we shouldn't behave, right? We were giving them sticks and carrots to behave a certain way, and out of the sudden we're like asking them to behave in a different way, and that's kind of what we're seeing. The second thing I'll probably say is cloud companies are also very unprofitable, especially the emerging ones. And I feel like we live in this health tech bubble where we like only see healthcare and compare them to like the Metas and the Microsoft of the world that are very profitable. But if you see and I was actually looking at a Twitter thread the other day, the S&P 500 has done really well, but it's really driven by a few companies that are very profitable, that are technology companies. And all of the other technology companies are all very unprofitable and not doing well. And the markets are not rewarding that today. So long-winded way of saying that I feel like the behavior has affected healthcare, but it's also affected the entire market.
Well, but
So,
Sophia,
oh,
go on ahead, Robin.
Robin, jump in, Robin.
Monopolize things.
oh, I want her to tell the story about Oshi Health, because all of us are looking at digital therapeutics. We're all kind of wondering what business model is going to make it and how we're really going to distribute this to patients. And so I read about Oshi Health in one of your reports. I'd love you to just talk about where the money flows and how they are actually approaching things like the business model.
Yeah, no, absolutely. And I think Oshi is a great example of like they are in the earlier stages of commercialization, but they've seen a lot of this flywheel effects on when you focus on your customer, both as the patient having great outcomes, and then also the return of investment to the client or who's paying in healthcare. There's kind of a nice reward flywheel. So Oshi, what they do is kind of a 3-6 whole person care kind of model for GI conditions. Think IBS, IBD, GERD. They have a GI who's part of your care team, but mostly is NPs, care coordinators, dietitians, and therapists that are helping the patient reach symptom control via kind of virtual first approaches. They also coordinate with kind of existing brick and mortar GIs and pharmacists that enable them to do the right scoping, diagnostics, and accessing the drugs that the patient needs. Oshi focused very early on with a third party, a big payer, to do clinical trials to quantify the savings that they would have for patients. So think of your qualitative outcomes on how fast did you get to symptom control? How did you feel over time? Patient reported outcomes, but a tons of claims analysis to see of patients that had diagnosed with GI, the number of reduction in scopes that they were preventing, or also reduction in drug spend, and then ED visits and other complications. And having that data actually enable them to renegotiate their contracts and be able to get paid more for their services because there was a clear ROI that the teams were seeing.
So I have a quick one about Oshi because I was round about one of my former, actually one of JL's former colleagues as well, was at the company, and this is a classic sort of messy venture capitalist story because all that stuff that you said to me is really true and very good, but not before they spent $20 million of mostly Takeda's money trying to become a DTC app company for GI with no business model, and then had to try and figure out what happened. And by the way, most of that 20 million got purloined by I think either BCG or Bain to build a bunch of stuff. And the consultant said, "Thank you very much." they were kind of lucky to get off the ground again. When Takeda came looked at it, went, we'll have all of our money. But what it's saying is that there is room there for a evidence-based virtual clinic. And you've seen some others, right? Virtual is a great example, and some of the others. And JL, you're building one of these things right now. So when you weigh in a bit on.
Well, so what I was going to say is first, I'm very close to the Oshi story. I know Sam Holliday really well. He's a friend and he's a fellow Wharton alum. And, the interesting thing, the question that arose for me, Sophia, is that, I really do wonder if the sustainable model, the model that's going to allow companies to be profitable in the long term, is a true value-based model, right? Where they're creating real value by reducing costs. So they're not just providing a great experience, a good-looking app, making patients happy, but they're actually reducing the overall cost of care. And maybe that is maybe that's a lesson that we're learning from Oshi. And as Matthew alluded to, thank you, Matthew, for the plug. My company is called Suntra Modern Recovery. We're a virtual support platform for families who are battling a loved one's addiction. And what we're thinking about is, addiction is a condition that really drives healthcare costs, whether it's the individual who is addicted themselves or the family members who have coexisting comorbidities, anxiety and depression, that is driven by an individual's addiction. So we think, the long-term play is figuring out how do you reduce the overall cost of care, particularly in addiction, where a lot of money is spent in a very ineffective way. A lot of it is driven by non-science, if you will, or pseudoscience. But I think that, as I think about Oshi and I think about a lot of other digital health companies that are thinking long game, I think really being able to create true value, reduce the cost of care, improve the overall quality, I think that's what's going to create sustainable profitability in the long term.
Yeah, and
Absolutely.
Sophia, if you feel that you want to drop a huge round onto Suntra Modern Recovery and perhaps buy out some of those early investors that maybe 10, 20, 30 times their investment, feel free. Don't stop. No chance.
Sophia, I don't mean to be tedious about this, but I am a digital health investor, so this is not academic. I'm not sitting here on my farm speculating about this. I've written six-figure checks to investing companies. I don't have billions of dollars in resources, but I believe in this modality. And I think it is the key leverage point in making our health system more efficient and meeting a lot of unmet needs. So there's no skepticism there.
Oh, for me, no, absolutely not. Value.
But please indulge an aging baby boomer's illusion that what I thought a business was something that met a unique need in a way that created value for customers and society, and that returned the cash invested in it by its investors in operating profit. And the reason why I asked you earlier about the time frame of investors is, if you have a 3-year time horizon, you don't need for what it is that you've built to be a business. You just need someone to walk in there with somebody's money and buy it. And that's what happened with Livongo. Well, it's not clear to me that Livongo was actually a business, but it sold to, for $18 billion, a huge chunk of which is now written off. And it's created a kind of an odor in the investment community. How many of the companies that you surveyed, and whether you invested in them or not, are actually businesses by that old-fashioned definition of generating more revenues than expense and returning the investment ultimately to shareholders?
I think that should be the ultimate goal of any company, right? I think it's just the timeline that you get, the timeline that you're getting to, and where you're making the investments to make that trade-off. Like, if I'm generating cash flow, I'm sending that to either through dividends or whatever mechanism to your investors. You're not investing that back on the business. So what happened is, instead of being cash flow generating businesses, they were putting it back on the business because they were being rewarded for growing fast. No one cared how much cash flow you were generating in the public market. But now that's being rewarded, and we're seeing the shift. There is a question of how can you rewind or change your behavior fast enough that the market is going to reward that. And that's what we're going to see a ton of these companies make it or break it. I am hopeful that there are great businesses that will be able to do that. even in the past, maybe 12 months since the market has changed, we're already seeing a ton of companies in the private market come back and be like, hey, we're actually growing really efficiently. And that's when I think the best companies are going to be built and grown. And, like everyone says, like great companies get built in this environment. And it's because of that scarcity mindset of you're doing more with $1. But folks didn't have that scarcity mindset before because it didn't matter.
So let me ask you, so if you say you're looking at that private companies that either you guys have invested in or you're looking at, do you think there is a substantial group of those percentage of those companies? Yes, there are going to be people who are, Babylon Health or whatever, who are trying to shooting for the moon and fell off disastrously and being missed incredibly and burned an incredible amount of money on the way. You've got particular areas, and I think you could pick the sort of paratherapeutics, digital therapeutics group who tried to go down a particular business model pathway that didn't make sense, and maybe Achilles is going down that pathway as well. Better therapeutics, others. But do you think there's a substantial group of companies who are going to be able to do what Jeff and I talked about, turn the switch on and become like other healthcare companies at some level, decently profitable, running tech-enabled services, even if they're not as profitable as a Viva or a Meta or one of these, or a pure play software company? Is that a fair? You think that now we're on that path, that we will see those companies emerge?
I'd like to believe so. Yes, I want to look at the glass half full and say that we can. I mean, I think.
But let me push you a bit.
Maybe you need more capital at the beginning.
You can't just write a report about how to do it and say I believe so. You must have some evidence. A chunk of them look like they're going to get.
Yeah. No, so look, like when you look at, can I show you a slide? And I know you've pushed on this one, by the way, sure. Matthew. So I am doing some more analysis to answer some of your questions. But so if you look at here, this curves, this is like the free cash flow of companies at each of the stages. And if you look at the 100 million plus, which by the way, a bunch of the tech-enabled services business is more like the 500 million top line, they're more efficient that the cloud software businesses that we see in kind of counterparts in our benchmarks. So you can get to kind of break even and cash flow profitability at the average in some of those companies. Let me see if I can show you the tech-enabled services. So here, top quartile companies are profitable. And then the average is -10 at the 100 million.
So for those listening on the podcast, not seeing the chart. So we're getting to above zero and above free cash flow. So in other words, starting to hit that point of where they're going to be profitable going forward at over 100 million companies for the top quartile of them. So it's still a bunch of them not going to make it, even if they're generating a fair amount. So you're going to see a fair amount of companies, maybe, who knows, 30% plus, 70% plus who are not showing that. Do you think that it gets better? I double the company again. I grow to, I'm disciplined. I grow to 200, 300, 500, 2 billion, whatever the number is, depending on which I'm in. Do you think that gets better and I become profitable the way that other health service companies have traditionally been profitable, possibly before the private equity guys come in and load them up with debt? Do you think that gets better for these companies, or do you think it's a struggle when they get bigger and bigger, or do you think we are going to see a bunch of them emerge, a la kind of the way Optima did in the past and those done, who get bigger enough, acquire other cheap assets, and become the new profitable companies that we were talking about? Is that a fair statement?
Scale absolutely helps you with contract negotiation, bigger, like bringing in demand and contracting and having higher fees, economies of scale in your operating expenses. So absolutely, scale will help you. And that's why you see kind of the really big healthcare services businesses be profitable. I think that what I didn't show in that chart, and you have pushed back and we've gotten great feedback from people, is like, how much capital did it take you to get to 100 to $1 billion? And we're doing some analysis on that. And like we generally look at on like the burn multiple or like efficiency multiple basis. And it takes a lot more capital at the early stages to get to 10 million, to get to 25 million. And then you start to see that efficiency multiple really switch and things get a lot easier to grow in terms of top line with every dollar that you're investing. So you can really see that economies of scale take place.
So I know you want to go to jail, but just for a second, Robin, you brought up at the start, CBS and others. We're now talking about these companies who got paid, who've been delivered a ton of investment capital, right? And maybe going to get there, maybe not. But they're now coming up in a world in which you got Optum, you got CBS Aetna, you got even Elevance, you got Walgreens, who've been getting into their businesses, getting into these, medical groups and whatever businesses. Do you think that maybe Robin, you can dive in a bit because you're talking about monopolies here, but I'm just wondering if in that environment, is it still going to be doable or are they going to be crowded out? Is that your good? Robin, say a bit more about what you started this whole thing.
So yeah, we're seeing a massive consolidation across all of the verticals you can think of, from pharmacy to pharmacy benefit managers to insurance companies and providers. And so what I'm seeing with companies like Elevance Health specifically, they've already partnered with Twill as well as Sidekick to have 5 digital therapeutics they send to their patients for free around things like Crohn's disease, COVID, and even maternal health. And so what I am thinking, the way digital therapeutics specifically could fit really well in this model and have potentially some pretty big exits if Optum or if CVS Aetna buys them, is the fact that most of the companies that they have bought recently provide care in the home for Medicare patients, and they're risk adjusted using value-based healthcare. And so I can see a world where that can add a lot of value as long as the digital therapeutic is designing themselves in a way similar to Oshi, where they were talking about really understanding where the money goes and then putting money into the clinical trials on how much Optum or how much Aetna can save, right, on the individual Medicare patients.
Jill, why don't you dive in and maybe you can explain why that means. The other question is, does CBS need to kind of build it itself? I don't know. Maybe you looked at this in the addiction space.
So I lost the train of thought that I had the question that I had for Sophia. I mean, look, I think, we've been talking about consolidation in this space for a long time, right? Like, that this was the whole story for so many startups. And it gets me to the question that I had for Sophia, which was, what is her inkling about the order of magnitude that you need to raise to build successful companies from the outset? So that was my question for Sophia. But, I think, look, we've talked about consolidation for a long time. And I think for a lot of startups, they can't really exist as independent companies because they can't raise enough money. They can't grow quickly enough. And I think that a distribution strategy through large players is going to be part of the story going forward, whether that's partnership or outright acquisition, as a startup founder myself, I'm very excited to know that you got Amazon and CVS and United and lots of people out there who are looking to, in the model of, make, buy or ally, they're looking to buy. And, I think this may be a good time going forward. And I think that's what you'll see. The only question that I have is about, I was talking about Biden at the beginning and his focus on anti-consolidation in the market and using the FTC to sort of prevent further consolidation, in fact, to break up monopolies and other things. So I don't think that'll impact how large organizations acquire startups, but I do think it's going to play a role in terms of how this consolidation happens over time.
Yeah. I mean, we've looked at Robin, a bunch of the vertical consolidation that's happening, and you think of like tech-enabled services or value-based care businesses. Who are the buyers if the public markets are not open and understand the intricacies of how long does it take to prove cost reduction, value, and obviously profitability? And then you look at the big 7, I guess, that own more than 50% of the healthcare spend, right? And those are the buyers. It would be great if there were more opportunities for exits for these businesses, because then you have more money coming in. And Jeff, your question of, are we building enduring businesses? Is it better to do M&A versus public? I think ultimately is where are you better fitted for a platform? Are you going to be, do you have a big enough lake to swim or grow into that the public market believes they can be kind of a standalone company? And if not, you should be part of a platform where you're going to also have a bunch of synergy and opportunity by being part of a bigger distribution network.
I just add one thing, which is that we're still, at some point, the folks running Amazon, Optum, whatever, they're not stupid. They're not necessarily going to overpay the way that it happened in the craziness of 2022 and the 21 when the public markets were overpaying anyway, getting these insane mergers. Having said that, on the flip side, and I don't know if it's still the case, I mean, Sofia, you guys raised a huge fund like a year ago, for over 3 or 4 billion or whatever. If I get on the healthcare folks, I know that B Capital just raised a big fund. Define just raised, all over 5 million. Define raised a big fund. Andreessen had a big fund. I'm missing somebody else who just raised a big, there's all this money sitting there ready to go to fund these big businesses on the, which is still around, even if maybe the Saudis aren't putting 500 million into 600 million into Babylon the way they were. But, again, it's like you can't make the equation unless you can see a really big exit. And none of the exits that happen from public companies, at least, into the big players like Signify or Oak Street or whatever, none of them happened anywhere close to where they IPO'd. They're all, yes, they were decent size, more medical, they're all decent size exits, but they weren't anywhere close. So, it seems to me, perhaps JL, you should dive in a bit more about how do you do this? How is the fundraising going with both sides?
No. So, well, this is my question for Sofia. We got an expert at like one of the best funds in the world. So you had alluded to it before. We were talking about it a little bit more, but you suggested that there's probably going to be a threshold in terms of the minimum you need to raise on the front end to be successful. And I think that's reflected in a lot of examples that I've seen of startups that are being incubated out of VC funds, often coming out with their $100 million worth of financing to attack or funding to attack a big problem. And it's interesting because it totally exists as a contrast to the lean startup model that was so in vogue for a long time. And for those of us who've been in this space for a long time, we know that it's really hard to build a lean startup in the healthcare space where you have to overcome all kinds of regulatory hurdles, all kinds of funding hurdles, et cetera. So again, what's your ballpark? What's your thought there?
It's a great question. And honestly, I'm maybe not the right person to ask this because we have not funded those companies that way. So we rarely incubate any companies, and we look at anything kind of seed to growth, but we tend to write kind of a $5 to $20 million entry check, which makes the Series A as kind of our sweet spot in kind of partnership. The reason probably why those companies were invested from the ground up, it depends on kind of the topics that they're working in. So we've seen kind of $50+ million rounds in kind of AI, LLM type of companies. And I'm assuming they're spending that money to build their own models and train those models and spend a bunch of that money on compute, right? So it's very capital intensive, but then they believe that you can hit a threshold where this model is going to be so good, then you can become kind of OpenAI for healthcare. There are others where you require that capital because maybe you have an acquisition model where you're going to go acquire physician practices or other types of businesses more in kind of the PE growth equity type mindset, and then you're going to use that capital those lives and patients and physicians to transition to value. So they're different models. To your point on like lean startup, I believe that there are ways that you can build in healthcare that is kind of lean from the ground up. And then there are also different types of capital that you can use at the early stages to test and grow. And it's about kind of how you build a plane while you're flying it, but also being very responsible with patient lives.
What scares me about the model that we've been talking about is the assumption that these big companies will automatically, even over a period of 5 years, just by applying discipline and capital and improving the management, improve their own profitability by doing this. CVS paid $20 billion for Signify and Oak Street Health. Oak Street Health, they paid $18 million a doc for admittedly a very well put together risk-based business for caring for older people. You tell me how you end up making money for your shareholders by grossly overpaying for trendy assets that you were really compelled to buy by commentary about what other people were doing, like Amazon. All of these big buyers have one thing in common. Their core businesses are failing. Amazon's retailing business is sputtering, and Amazon's earnings are what they were 5 years ago in 2018. Even the returns on Amazon Web Services are falling. They've gotten into and out of healthcare businesses and are laying people off in their healthcare operations right now as they're going about integrating One Medical. So we've made an assumption that value is being created by these folks buying these businesses that I'm not sure the managements of these organizations have the capability to produce. And in CVS's case, Aetna lost $1 billion because the star ratings on their health insurance plans, their core business slipped.
Yep.
$1 billion squandered. They were sued by one of their largest ASO customers, Kraft Heinz, for incompetently managing their ASO account. So we're assuming the ability to execute, that is the ability to leverage these investments in a way that not only the shareholders notice, but us customers, us seniors notice. And I think that's assuming a lot. Let's just put it that way. I'm not sure that this model of leverage it up to 100 million and sell it to one of the bigs for 5x revenues is something that's going to last very much longer.
I agree, and I guess that gets us to a fundamental point, which is it doable to have what we've had over the last few decades, right? Which is if you run a essentially fee-for-service, well-organized services business, take HCA as the predominant example, but many others, right, across, and all the ones that have been bought by PE companies, that were figured out the way to tap into the spigot. Jeff, you've been talking about the spigot, fee-for-service medicine for 40 years. Tap into that spigot, you did fine, right? And that was good for many, many years. I don't know if it's good in the future. We're seeing those big hospital systems, who we discussed, come back, still not be very profitable post-pandemic. Seem to be struggling with different parts of it. There are individual parts of the marketplace, PBMs and others, who seem to be very profitable, but I just look across the board and go, in a world which, as JL says, the Biden administration is concerned about costs, we're concerned about monopolies, and doesn't look like many of these exits that we've seen from the digital health or any other part of the healthcare M&A world are doing that well. But all those management teams are feeling the desperate need to go do something, whether it be in home care or Medicare or whatever else. I'm with you. I'm really concerned the overall model for sort of capitalism, if you like, in healthcare is kind of in trouble. I don't know. Sophia, you raised a ton of money and you just got into this business recently, so you must be more optimistic than we are.
I see a bunch of the issues that Jeff has brought up, right? But if we don't change the way we operate this healthcare system and believing that innovation is going to be that way of kind of aligning incentives and building businesses from the ground up, leveraging technology and kind of funding those upstarts, how are we going to change what's happening? Is there regulation?
No, honestly, I'm a Medicare Advantage subscriber, so I'm like right in the demo where all of this money is going. And I keep waiting for my life to change because of my MA relationship. So I'm an empiricist. So far, what I've mostly been is bombarded with robocalls from Signify to send a nurse to my house to upcode me. They haven't added a dime's worth of value to my life. So I'm waiting, and I'm like, I'm hungry for this. I'm with you. I have the same level of impatience with the fragmented, poorly focused healthcare system that we have now. And I guess I'm just, maybe the problem is that it is so damned complicated to solve this problem at scale for billions of dollars, millions of subscribers, that it's just going to take a whole lot more time than any of us thought. I mean, I really want our healthcare system to get better. And I'm dazzled by a lot of these companies. I think they've got great ideas, but I think what's crippling us is that stuff just flat out doesn't scale in this business. And I'm not sure why it is. I've been in it for 48 years. I don't understand why almost nothing scales in this business, and that after all this tech investment and all this innovation, 3/4 of the profit in this field is still in the pharmaceutical sector, where it's protected by patents.
Robin, can you dive in here? You've been looking at this, and both you've been at all ends as a patient and as a advisor, investor in some of these companies. What's your take on? Is it going to get better? I don't want to moan about my experience trying to get an appointment for my back 6 months ago. But you're in that world every day, so
So it depends on the patient and what the problem they needed solved, right? And so thinking about some of the, I have Crohn's disease, right? I've been on Remicade now for over 20 years. And for the past 7 years, I've been getting it in my home. And it has been a massive game changer, right? So providing that care in home for dialysis, IV medication, and hospital at home. In fact, my hospital was charging $28,000 every time for Remicade. 2% of the population are on specialty drugs, and those specialty drugs, about the top 10, really make up almost 50% of all drug spend, including Remicade. And so by moving it into the home using option care, it changed the game. In over a 5-year period, I've saved over $1 million in top line billing. $1 million on a medication that I'm on for life. Right. But not only that, but it's changed the equation. And I'm hearing this across the Crohn's community and through my nurses. It used to take me a week to recover from getting Remicade in the hospital. And I work in pharma, right? I'm like, oh, it's because of the mouse protein that's in it, or even just the human proteins. No, when I moved it into the home, our recovery time went down to 0 days. And we are hearing this across the Crohn's community because, a hospital environment is things like the chemicals there, the infectious disease, the chronic noise with the sheer number of alarms that are constantly going off with IV poles. And just that one example in that one community, that has already made a massive impact. And so it's going to come down to who the patient is, what is wrong with them, and if they're Medicare or if they're on a private plan.
Yeah, I mean, I think that's right. There's probably a lot of little things that most people from the outside don't consider that matter to patients, which changes have gone for the better. But I'm with, I was talking to a colleague of mine who was working at UCSF, which by incidentally apparently just laid off all of its digital health people and started to centralize it all. So a lot of their interesting initiatives to, the different clinics were doing to try to, use these different tools have been killed and gone back to does it fit into the central model? Can we plug it directly into Epic? And some of the things that got killed were trying to improve internal referrals and trying to fix the phone system. And I'm going, come on, this is the stuff that everyone knows is a nightmare getting hold of when you want to get hold of a new specialist in an academic center. So and I'm with Jeff. I see all of these, I've seen them for obviously, JL, you and I saw them for those years at Health 2.0, and I continue to see them, all these different solutions that you think, why the hell wouldn't this be here and scale everywhere? And for some reason they get, they kind of get rejected by the system. I think, Sophia, that's the problem so many of these companies have run into, is that they don't manage to get, this is a better way of doing ABC, whether it's in analytics or whatever, and it just seems to get spat out. Or you end up with the complication where you're a telehealth company and no one knows who you're competing with, because there's one for your medical group, one for your plan, there's one for direct consumer, and who knows. Right.
Yeah, or the incentives are misaligned for the different stakeholders, because the patient is one stakeholder, but there is a payer, there's a pharma, specifically, Robin, in the example that you're giving, right? Of
Yep.
The reason why it's better for you at the home, but if they were making more money at the hospital, they would never enable this. But the payer is probably setting up the program, probably has the right rebates. So the business models that can really align that and put the patient in the center, in my mind, are the most interesting businesses to back.
Yep.
All right, so we're very close to the end of our hour, and we do a traditional wrap up at the stage where we go around and ask people what they're interested in, what they're looking at. And I know that JL has to hop off in about a minute and a half, so JL, we will start with you and then let you hop, and then I'll let everyone else fit it. We'll squish over the end of the hour for everyone else. So JL, tell us what you're up to, what you're looking at, what's coming next.
Thank you, Matthew. So I think the thing that I'm really interested in now is what's going on with Medicaid, right? Now that the public health emergency is over, states are purging people off the Medicaid rolls. From what I read, that there's been 1.5 million people purged from Medicaid already, and there is 3 million. And
3 million.
3 million. And
most of them in Arkansas, Florida, right?
And I didn't realize that was off of a base of 93 million people. Wow, which is, I never realized that Medicaid was that big. So I think that's a big story, has all kinds of impacts on people, real people and their lives, but also the health system that is very dependent on being able to get paid at least something from people who often have the ability to pay nothing. So I think that's an important story and something to watch as we go forward. And with that, thank you, everybody. Sophia, pleasure. Robin, Jeff, great seeing you. And Matthew, as always, thank you very much, man. I appreciate it.
Thanks, JL. All right,
okay,
Robin.
Bye-bye.
Robin, what's your next? What are you up to next? Touring the world.
I have never heard JL talk that quickly before. So, right?
Well, it was probably, he's got a venture capitalist calling him immediately after this. Probably Sophia, something like that.
There you go.
I'm
so
kidding.
I've added.
I know it. He may actually have a real patient. You never know.
He is a physician, right? So on the end of a lot of my AI keynotes that I give for corporations, I've added generative AI. And so I am really interested in the generative AI space, the medical scribes and the summaries and things like what Carbon Health are doing with theirs. So that's where my eye is for the next week.
Yeah, and you assume there'd be a ton of savings coming there somewhere, and everyone's very confused about that part. I would point out that we talked to a venture capitalist for 46 minutes before she mentioned AI. So either, I don't know if you,
Oh,
I don't know how you managed to hold out so long, Sophia, but I think that is fascinating, and I haven't gone and looked. Yes, that's a great book by a certain book. I forgot you wrote that one. Yes.
I love that. Send it to me.
Yeah,
Oh,
absolutely.
definitely.
I love it.
I'll buy it.
Robin, by the way, has been the queen of using other people to write her books. And have you had AI write a book for you yet? Let's chat.
No. And this one actually, I just wrote almost straight through.
You have to write it yourself? Oh my God, that sounds like a lot of
Yes, but
that's how Jeff writes his books. It's ruined his life. Jeff, what's next with you? What are you looking at?
Well, it did buy me this farm, so I mean, like, at least there's
you sure it was that and not the Sterner board seat?
some ROI to it. Well, where did the Cerner board seat come from?
Anyway, that's why Senator put me on board. I didn't write him a book. Sorry, go ahead.
Next week, one way or another, I'm dropping a piece on the history of vertical integration in healthcare, and an argument that Kaiser's success in this space wasn't because it was vertically integrated at all, was because of its market position. And that we need to seriously reconsider whether vertical integration actually creates value in our field and what to do about it. So I've got a piece coming on vertical integration, and it's a mea culpa. I was one of the first people to write about this idea in healthcare, was a strenuous advocate of vertical strategies. I think they've failed. And I'm going to share the reasons why I think that and what we ought to do now.
I really look forward to that. Just to point out, when I had a fewer gray hair, more hair and fewer gray hair in my beard, I saw you, Jeff, talk, I think the first time we met, in the UNGA, an organization which doesn't really exist anymore, somewhere down in Southern California where I am now, talking about virtual Kaisers and vertical integration in 1994, something like that. A while back.
I've been a big advocate of virtual models, right, and of delegated risk, and of sharing profit and premium. And I think that idea has a great deal of merit, as much or more merit now than it did when you heard me propound it. And I just think I think we've reached the end of the line here on this idea, and it's time to move on.
Well, we should absolutely do. All right, Sophia, let's leave the last one with you. Thank you very much for coming on. What do you, which company do I quickly spin up so you can give me a few million to get going? And I'll rephrase that. What else?
Just say you say that you're doing something in AI, and
fine. You'll just send me a check. That sounds great. But give me a sense about what you're working on at Bessemer, what you're looking at, and where you're going with the next level of research. Because I'm seeing a lot more VCs do research. The folks at 7Y put out a big thing about at-home care. You guys are doing this work. You know, the VCs are actually like putting the poor consultants and researchers out of business now.
So after looking at this 100 companies, realized that 80% of the companies are tech-enabled services, only 20% are software. And I just been enamored by this idea of like, why can't we build software businesses in healthcare, and why is it so hard to adopt technology? So I'm deep diving on that space, hoping that with all of the great improvements with AI, machine learning, and generative AI, we can automate services and make it software-like, so we can adopt more software, which ultimately should drive costs down and improve interoperability and all of that. So that's where I'm spending time.
Awesome.
Fantastic. I will have to discuss the interoperability I've been seeing at the Disneyland last night where I was. Somehow they built a fantastic new Star Wars Emporium where you can play, but everything else in the healthcare system is like the old part of Disneyland where, you know, you go into the Tomorrowland, which was built in the 50s, where they still have two-stroke gasoline-powered cars for you to drive around, which are causing massive pollution. You're going, you sure that's what Tomorrowland should be like? So the future in healthcare is always unevenly distributed, much like Disneyland. Fantastic. Okay, well, you have been listening. It's come to the end of an hour of THCB Gang. I'm my guest today were Jeff Goldsmith from West Virginia, Robin Farmanfarmaian from the Montana, Palo Alto, Toronto Neptune from the island of Manhattan, and Sophia, you live in Boston, right? Is that correct?
That's right.
Sophia Guerra from the academic intellectual town of Boston, investor at Bessemer Venture Partners. Sophia, thanks a lot for coming on and joining us. You've been listening to Matthew Holt. This was the THCB Gang. And it's the wrap on the July the 20th edition. And then we will be back next week with another different gang. I think our friends from Dime, Jen Golsak and her team have got some fun stuff to talk to us about next week. So we'll look forward to that. And with that, goodbye for now.